doing a Master of Business Administration from Indian Institute of Management in Calcutta. And later he received a Doctor of Philosophy, PhD in Financial Economics from University of Chicago, Booth School of Business, where I understand the former RBI Governor, Professor Raghuram Rajan, has worked with Professor Raghuram Rajan in his thesis, who also happened to deliver a couple of lectures here as a governor and also even before he became the governor. So without further ado, let me invite Dr. Subramaniam to deliver his speech. Thank you very much.
Yeah. Yes. Can you do a slideshow? Yes. Thank you very much, Governor. Esteemed dignitaries, including several of the governor's colleagues, governors themselves, and the esteemed audience. Let me first start out by thanking you all for providing me the opportunity to share my thoughts. This is based on a book that has just been released. The title of the book is Money, a Zero-Sum Game. We've had the privilege of a foreword on the book by the Honorable Finance Minister, Ms. Nirmala Sitharaman, and several luminaries, including former governors and current ministers in the Indian government, have been kind enough to read an early draft of the book and give some advance thoughts on the book, including Dr. C. Rangarajan, who, of course, was the RBI governor and also chairman of the Prime Minister's Economic Advisory Council, Dr. Arvind Panagaria, who worked as the vice chairman of Niti Aayog, the new version of the Planning Commission of India, current ministers, Railway Minister Ashwini Vaishnav ji and Piyush Goyal ji, and Indra Nui, the former chairperson and CEO of PepsiCo, and Dr. Rajiv Kumar, who also had been the vice chairman of the Niti Aayog. So I'm going to talk about this. Just excerpts from the book. The book is available on Amazon. Hopefully, I'm able to develop some interest in the book among you, through this. So the title I chose for the talk of Monetary Policy in a Changing World, I think is apt because the ideas for this book started germinating in our minds after the global financial crisis. So these ideas have been brewing since then, and of course, during COVID as well, we were able to think through, my co-author and I. This is co-authored with Professor Vaidyanathan, who incidentally happens to be my younger sibling, 2 years younger, who's also a professor at the Indian School of Business. So the key objective why we wrote the book is to develop a new framework for money. Now, the question that will arise is, what is the need for a new framework? One can, try and motivate the need for a new framework only if the existing framework is not working. So what is it that is not working, in the current framework? So if we start, and the governor very rightly mentioned as well, there's been a sea change in monetary policy tools since the global financial crisis. Following the global financial crisis, central banks across the world, not just in India or Sri Lanka or emerging economies, but even in advanced economies, pulled out what many commentators have called them bazookas, heavy artillery, to try and stimulate economic growth. And a lot of the unconventional monetary policy, which has led to balance sheets of these central banks multiplying several times, are part of these monetary bazookas. And yet, economic research, generally economic research does not agree on a conclusion, but by far the conclusion, at least on some of this unconventional monetary policy, seems to be that it has failed to stimulate growth. If you look at in the advanced economies, on average growth post the global financial crisis is 1% lower than the than economic growth, than GDP growth, pre-crisis. So clearly, it seems like these monetary bazookas, and provocatively, I will actually say that these have proved to be damp squibs. The question is why? Why is it that these have not worked? And our thesis in this book, and which thesis that we develop conceptually, but also provide empirical evidence using the using cutting-edge econometric methods, is that monetary policy that has been implemented derives from a monetary theory that is flawed. That's the essential thesis that we are advocating. So now, as Governor was mentioning, I started out as an engineer. I then have happened to come into economics. One of the maybe advantages or disadvantages of being an interloper in a profession is that you try and compare across professions. And when I compare some of the epistemology of natural sciences and engineering with economics, sometimes I wonder that while theories in natural sciences and in engineering are often developed to try and explain the real world, in other words, the theories start from the real world and then, theories are constructed. The Newton's laws of motion, for instance, are a very good example of this. Oftentimes in economics, theories are actually constructed with assumptions like, representative agent, who represents the preferences of all the people in the economy, rational profit maximizing, a utility profit maximizing firm, or utility maximizing consumer, and aspects which oftentimes are while many of us economists will try and defend those as abstractions, are also those that don't necessarily sit as well with the reality. And so, one of the things that I've always found is that, collectively economics has far more puzzles than all of the other disciplines put together, because the theories that are constructed and the predictions that come from those, when one takes it to the real world, oftentimes the predictions don't quite match with what we see in the real world, and that's then called a puzzle. In other words, the direction basically, instead of observing the real world and then constructing a theory, it is, the theories constructed, predictions are derived and then taken to the real world. And if it doesn't fit, instead of calling the theory wrong, the real world is basically called a puzzle. And that's why puzzles proliferate in economics far more than any other discipline. So I think that the spirit of what we are, we've done in this book is essentially captured by that. In fact, in the first economic survey that I wrote, what I've just mentioned is actually, it's part of actually the literature now. The economic survey, there's a box, very first box in the first economic survey I wrote had this essentially showing how the epistemology in economics seems to be at variance with those in other disciplines. And I think as a result, oftentimes we get theory that does not necessarily help us to understand the world well, and thereby gives us predictions that also possibly don't work as well. So I think that's the spirit with which we basically have written this book. So combining our experiences as engineers And especially one of the things that we learned is thinking ab initio, thinking from first principles without any color of ideology, without any color of prior assumptions, just starting from first principles, build up. Second, we both of us worked as bankers before we went and did a PhD. And so had actually seen how banking works in the real world, and that real world experience, we've then combined it with research, the research experience that we've had as academics. So the combination of engineering training with practical experience as bankers, together with the academic rigor that we've developed in being able to publish in the leading journals, I think is that we've combined that to write this book. So primarily what the book does is it highlights the flaws in the current monetary theory. I'll give you examples of some of those. And these flaws are not just, this is not a book that is written for India or for just the emerging economies. What we're talking about is equally applicable to the advanced world as well. So we highlight the flaws in the current monetary theory and thereby then develop a new monetary theory, which helps us explain why the monetary bazookas were damp squibs, and then suggest policies that can be effective in the real world. I may not have time to go through all these four. I'll try and give you a sense of all these as much as possible. So what I'm going to hopefully cover, I'll be able to cover maybe the first three parts, not as much the fourth, but so I'm going to start by first showing you some real phenomena that monetary economics cannot explain, and then I'll try and give you a sense of the new framework for money that we have. How does that rationalize these puzzles? And then finally, what could be some of the new insights that we can obtain? That's in the third section. I will not have time to actually go into the power of the banking sector, but I think part of if there's one key message that we want to convey through this book, it is that the banking sector collectively has far, far more power than the current literature has recognized, because they are the dominant creators of money in any economy, so in some sense we basically think about banks as money creators. Those of you who follow the economic research very closely, this year's Nobel Prize given to of course Professor Doug Diamond, who I had the privilege of learning financial intermediation from at the University of Chicago, and Ben Bernanke and Phil Dybvig. The Diamond Dybvig, is basically the canonical model of financial intermediation and bank runs that all of us learn when we during our PhD programs. But I think we do sort of raise questions about that particular view of banking. The view of banking that we advocate in this book is banks are money creators, not just financial intermediaries, and that's something which hopefully I'll try and give you color on. So let's start with some phenomena that monetary economics cannot explain. So one of and this is something we've all learned in our if there was an undergraduate class that we took in monetary economics, or even in graduate school, we are taught that the money multiplier, it's a very important concept in monetary economics. The money multiplier is basically, captures the multiplication that happens through transactions, deposit and loan transactions, all through the, through the monetary system. The monetary theory, current monetary theory, is basically says it's the reciprocal of the reserve ratio, and the reserve ratio essentially is the minimum, a proportion of the liabilities of the bank that has to be kept with the central bank, and we all know why that is required, because banks essentially take liquid assets, liquid deposits actually, and convert them into illiquid loans, and therefore to make sure, if there is people, a certain section of people want to withdraw their deposits, then this reserve is kept. Now, notice here in this theoretical prediction, there is no other variable that the theory predicts will explain the money multiplier. It is only the reciprocal of the reserve ratio. So now I'm going to, with that theory and that prediction, I'm going to take you through some of the actual evidence. Let's fit this to the real world. So let me start with the United States. So this chart here shows the multiplier, empirical money multiplier, which is the ratio of broad money to narrow money, in the United States. Notice here, so this is, I don't know whether the years are visible. The years are it starts from 2003 to 2013. So 5 years before the global financial crisis in 2008 to 5 years after. Notice that the multiplier was about, between 8.5 to 9 before the global financial crisis, and then declines precipitously after the global financial crisis, and continues to be between 2.5 to 3.5, during the period after the crisis. Now, what did the central bank, what did the Fed do during this time? Fed actually did not do anything in terms of the, in the reserve ratio. The reserve requirement remained constant at 10% all through this 10-year period. I think it is important for me to emphasize that. If it is the case that the reserve requirement was kept at 10% all through this 10-year period, then what monetary theory would tell us is that the money multiplier should have basically been the reciprocal of 10%, which is 10, and it should not have changed at all. So theory says there should be no change in the money multiplier, and yet what you find in the data is a drastic decline in the multiplier, which is not explained by the theory. That's the first piece of evidence. Let me start with the second. This happened during COVID. So Fed abolished the reserve requirement, 10% reserve requirement, on 26th of March 2020. So this was during the COVID period. So if it abolished, what does that mean? Your reserve requirement now is, for the US banks, it is zero. Essentially, it's completely abolished it. Now, if the reserve requirement has been brought down from 10% to zero, what should the theory then say? That the multiplier should have been 10 before and should go to infinity, after, because the reserve ratio has been brought down to zero. In other words, at the very least, the theory should tell us, theory tells us that the money multiplier should increase because the reserve ratio has been brought down from 10% to zero. What do you see in the real world? This is again the empirical multiplier shown from September of 2019 to September of 2021. So, 1 year period before and after. Again, you see that the money multiplier has basically, firstly, it was nowhere close to 10, before this change. And after the change, the money multiplier decreases instead of increasing. I mean, the theory would tell us basically that there should be an increase because the reserve ratio was decreased from 10% to zero. And yet what you see in the real world is, exactly opposite of what the theory predicts. So that's a second piece of evidence, on this. In the book, we show this not just for the United States, but for each one of the OECD economies. Each one of those OECD economies, the evidence is there, and I refer you to those, where the reserve ratio is not changing, or actually, is changing in one direction. The prediction is basically that if the reserve ratio declines, multiplier should increase, and yet it does not happen at all. So across one after the other OECD economies, we show this. Then let's come to, I have some here. This is United Kingdom. No change in the reserve ratio. Multiplier is all over the place. Second, this is basically Australia and New Zealand. We have then Japan and Norway. Next, you have South Korea and Switzerland. Then you have Iceland and Denmark, and then Chile and Turkey, and Czech Republic and Israel. And in all of these, actually, the money multiplier, as you can see, is all over the place, without much change in the reserve ratio at all. So it's not just for the United States, but for each one of these OECD economies, this theory that the money multiplier is a reciprocal of the the reserve ratio is not working. And this is really critical. It's very important because a lot of conventional monetary policy that is done by central banks is based on the theory of the money multiplier. Why? Why did central banks cut the reserve ratio during times of let's say when the economy is not doing very well? The idea there is that monetary base times the money multiplier is basically the broad money in the economy. We can think about M0 or M1 as the as the monetary base. Because this is a central banking crowd, I'm actually not going to go and explain what M0 and M1 etc. are. So I'm going to presume, in the interest of time, So let's take the monetary base as M0 or M1, M3 as the broad money in the economy. So monetary base times the money multiplier is equal to the money supply in the economy. The idea is even if the monetary base itself does not change, if you increase the money multiplier, you will actually increase the supply of money in the economy, and that is why central banks cut the reserve ratio to try and increase the money multiplier. But what has happened actually is, even though central banks have cut the money, the reserve ratio, multiplier has not increased. So, one key pillar of conventional monetary policy does not seem to be working, and that is something which is important for us to ponder. One as those that have interest in monetary policy, but also as those that actually think about monetary theory itself that leads to this prediction. I'll also give, because this is a country that I'm from and I track very closely, from India. So before the global financial crisis, in India, the reserve ratio was 9%, and the Reserve Bank of India decreased the cash reserve ratio from 9% to 5%. Again, what should you expect? From 9% to 5%. If the theory is right, when the cash reserve ratio is 9%, the money multiplier should be the reciprocal of 9%, which is 11.1. So multiplier should be 11. When the reserve ratio is decreased to 5%, reciprocal of 5% is 20, and therefore the multiplier should basically go from 11 to 20. Actually, what happened was the multiplier just remained range bound between 4 and 5. It was not close to 11. When the reserve ratio was 9%, it was nowhere close to 20. In fact, it basically remained range bound. In other words, theory tells you that this decline in the reserve ratio. And why did the Reserve Bank cut the reserve ratio? Hoping that the money multiplier would actually increase, but that did not happen at all. And so clearly, the real world seems to be actually dancing to a completely different tune to what monetary theory tells us. Similarly, during the COVID crisis, again, from 5%, which was basically, as I said, after it was brought down to 5% during the global financial crisis, it continued to be at 5%. Then the Reserve Bank cut the CRR during COVID, again, another crisis, from 5% to 3%. Again, what should have happened? The reserve ratio is cut, multiplier should have gone up. That's what theory tells us. I think simple theory, but what happened in reality, the money multiplier actually decreased, not increased, decreased from 7 to 5 in 2021. Again, clearly, what is happening in the real world is completely at dissonance to what the theory tells us. So that's the first set of, which basically we kept looking at these, ever since the global financial crisis, we've been looking at these multipliers and say, something doesn't seem to be working for sure. It's not, this is really, theory is not really working in terms of, a second key, and this is what has, the governor mentioned this is a second premise that has driven a lot of unconventional monetary policy, especially in the, in the central banks of the advanced economies, QE, quantitative easing. One of the key premises that has basically, driven unconventional monetary policy is that if you essentially give more bank reserves to banks. In other words, relax the constraints that there might be on bank reserves. If banks have more reserves, they will go and lend more. In other words, bank reserves and lending, bank loans can actually substitute for each other. So what has, as part of QE, what has the Fed, for instance, done? Bought a ton of MBS, mortgage-backed securities from the private sector, and the Fed's balance sheet has increased 7 to 8 times. In fact, if you look specifically here and look at the chart on the left. The chart on the left shows from, again, the same 10-year period during the global financial crisis, the reserves of the commercial banks, in the U.S. So notice that the bank reserves were, you can see the line seems to be almost close to zero, in the up until 2008, because the bank reserves were only 14.9 million. The axis here actually on the left panel, the axis is in $1 billion. So clearly, the reserves before the global financial crisis is minimal, 14.9 million. After the crisis, as you can see, in 2013, the reserves have increased to $2.5 billion. So that's a multiplication of 167 times in the bank reserves, from from $15 million to almost to 2.5 billion, almost a 167 times multiplication in the reserves. If the theory were right, that should actually show up in bank lending, right? That's what should show up in bank lending. The fact that reserves have been released so much bank reserves has been released, bank lending should have actually grown. Now look at the chart on the right. The chart on the right shows what you see as shaded bars. Those gray shaded bars is the actual lending that happened in the US, actual lending. And notice here, so there is actually a decline in the actual lending after the global financial crisis. If we compare with the trend that should have prevailed, and the bars with the white portion in it and that trend line shows this is what the trend should have been. If the trend had continued, then actual lending should have been what is being shown up until the white bar. So compared to that trend, actually bank lending declined even more. So counterfactually, in other words, compared to what the trend should have been, bank lending has declined even more. Again, one of the key premises of monetary theory, that releasing bank reserves should actually lead to lending, that has not worked in actual numbers, because the actual lending has gone down. Not just that, compared to the trend that prevailed, which is the right way to compare. All of us, here, understand economics, that we should be comparing with the trend that prevailed. When you compare to that, actually the decline is even more. So again, another key, a fundamental premise of monetary theory does not seem to be working in the real world. And why did if you ask the question, why did central banks want to stimulate bank lending? Because they wanted growth through bank lending. We know very well, when bank lending goes, basically bank lending is done to good projects. That leads to output creation in the economy. But that has not happened. That is why if you look at research, there's a lot of research now. It's been almost close to 15 years after the global financial crisis, which looks at the economic impact, the growth impact of these, the QE programs and the unconventional monetary policy. And, most studies seem to find not much impact on, even those that find the impact is actually very, very marginal. Now, if you're talking about almost 170 times multiplication in bank reserves and a 7-8 times multiplication in the Fed's balance sheet, then, the impacts of that, basically, these are bazookas. This is heavy artillery that's been pulled out. And, the impact on growth is basically either non-existent or is marginal. Question that needs to be asked is clearly, what is happening in the real world is not consistent with what monetary theory is telling us, and therefore the monetary policy that is being driven based on this theory. It's as if, let me give you a parallel. Because this is something most of us understand. If suppose, let's say, medical theory comes up, and based on whatever research they do, they come with a prediction that if you have a viral fever, antibiotics should be given. If that's the theory that researchers in medicine advocate, what will doctors do? Doctors are the implementers of that theory. They will prescribe antibiotics when a person has viral fever, or and now the patient will not improve because that is not the right prescription. But either of two things, either or maybe and two things are happening. Doctors themselves actually, in their pride in their profession, they're not acknowledging that the patient is not improving. And because they're not possibly acknowledging that the patient is not improving, they're not communicating back to the researchers that whatever prediction that you're coming up with, your theory is wrong. That antibiotics should not be given when you have viral fever. That, to me, in some sense, captures basically monetary theory and the monetary policy that is being driven by monetary theory. The patient, which is actually the economy, has not recovered. So I think this is the the key aspect that I wanted to. I mean, if you look at, again, in India, I gave you evidence for the US. If you look at for India, these are actual statements. Around this time, global financial crisis, the finance minister then kept lamenting about, the fact that banks are not lending. And it's an actual quote from, he says, despite the loosening of CRR limits, CRR is basically what? That's a reserve ratio. When you loosen the reserve limits, what happens? Bank reserves get released, which is basically that's the theoretical prediction that lending should have gone up. And he says, credit creation continues to be elusive. Bank credit has been steadily declining. And in fact, if one goes and reads the economic media in India, this word lazy banking, every, a commentator seems to talk about on the premise that, oh, look, banks are sitting on so much reserves, bank reserves, they're not lending, lazy banking. But what we are highlighting is that it is coming from a premise that is, that is not doesn't seem to clearly work. So this is a key part of basically what is not working in the real world. Now let me get on to, so I've basically picked holes in the current monetary theory. Now I'm going to transition into what is it that we are actually talking about. So at this point, I should take a couple of minutes to explain, the key premise of some of the, let's take the theory of financial intermediation. The theory of financial intermediation, which is basically what, banks are viewed as financial intermediaries. What does that theory say? It says that banks take deposits. These are essentially liquid deposits because the depositor can come and claim that deposit at any point in time. He may come and deposit it just now and claim it the next instant. And they convert it into illiquid loans because these loans are 5-year maturities, 10-year maturities. So it's as if basically a parcel of liquid, think about it as liquid milk, parcel of liquid milk is being taken, converted into illiquid ice, but passed over. Some transformation, maturity transformation, liquidity transformation happening, but it's still as a passing of the parcel, taking deposits, the intermediary is just basically passing it on as loans. So that's what an intermediary effectively is, right? If you think about a FedEx, FedEx is an intermediary essentially between those that have to send some parcel and those that have to receive a parcel. They're actually passing the parcel. Now, this theory views banks as intermediaries and thereby, in fact, does not make a distinction between banks and non-banking finance companies. For instance, the NBFC is doing the same thing as well. The non-bank finance company takes a loan from the bank and gives it to their lenders. So in the theory of financial intermediation, for instance, there is no distinction between banks and NBFCs. But here's where we put this theory to test using very careful. Those of you who work in econometrics, would and the Nobel Prize last year was given to Angus Pischke and his co-authors for some of these, some of the cutting-edge econometrics, what is called the regression discontinuity. This is called the RDIT design, which is there's a discontinuity or a natural experiment. So the demonetization in India, we use that as an experiment. What's the advantage? During demonetization, it was only a 2-month exercise. 2 months where the deposits increased significantly. In fact, deposits increased by 8.5 lakh crores. Now, if the theory of financial intermediation is right, what should have happened? You've taken a parcel of 8.5 lakh crores additional deposits. That should have actually led to greater lending. That's what the theory of financial intermediation, essentially, the prediction is that deposits lead to loans. Now, if that prediction were true, an 8.5 lakh crore increase in deposits should have led to some increase in lending at least. Now, the advantage of this natural experiment is that nothing else is essentially going on. In a small 2-month period, GDP growth did not get impacted that much. So it's a nice natural experiment where confounding factors, which all of us who do research in empirical research worry about, that there may be other things that are going on. That's not happening. And what do you see here? Look at the chart. So on the left side is basically the chart on deposits, and on the right side is the chart on lending. Here again, I'm showing you the actual lending and the lending compared to the trend that should have obtained. So deposits increased by 8.5 lakh crores during this time, and lending actually declined by 1 lakh crore. Again, the key premise, theory of financial intermediation, which is what is a bedrock of the theory of the monetary theory, is not working. Some of you will actually will be thinking here, oh, what gall, going and challenging Nobel Prize winning work? That I'm sure some of you may be thinking. But one of the things I learned when I did my when PhD at the University of Chicago, I was told is that every research is work in progress. Every research is work in progress. It may be that the Nobel Prize winning research is actually higher quality work in progress, but it still is work in progress. And when you have actually evidence that challenges that, I think it has to be, research has to go by not the person that basically, who's advocating the theory, but the actual, the content of the theory. The content of the theory is that deposits lead to loans. That does not seem to be happening in reality. So clearly something is wrong here. So to summarize, let me, how much time do I have? 10 minutes? Okay. So I'll just quickly, summarize and then give you a sense of the theory itself. So money multiplier, as postulated by monetary theory, fails to explain what we observe in the real world. Increasing bank reserves does not seem to be leading to more bank lending. Monetary policy efforts by central banks, so-called monetary bazookas, post the global financial crisis and, during COVID do not seem to have worked. Deposits do not cause loans as predicted by the theory of financial intermediation. So what is it that we basically, what's the framework that we offer? And that will also allow me to explain why the title Money as a Zero-Sum Game. Let me, without getting into the slides, just intuitively explain the key aspects of. So think about how, I'm sure many of you have gone and borrowed loans from banks, right? What happens when we approach a bank? So suppose I approach the Bank of Ceylon here for a loan of 100,000, Sri Lankan rupees, let's say. Will the lending division there first go and check whether we have deposits? No. They're going to basically first, what they're going to do is they will assess my credit. They'll look at whether I have the ability to repay, whether I have the willingness to repay. And if they're convinced that I have both, I have the ability to repay and the willingness to repay, they will sanction me that loan. And when the loan gets disbursed, what happens when the loan gets disbursed? My bank account actually gets credited to the amount of 100,000 Sri Lankan rupees. So I asked for a loan of 100,000 rupees, and what has that done? It has basically gotten credited in my bank account as 100,000 rupees in deposits. Now think about what does this do to the balance sheet of Bank of Ceylon. Now compared to earlier, both the assets and the liabilities part of the Central Bank of Ceylon's balance sheet have increased by 100,000. Why? Because the asset, which is the loan that is given, to me, is an asset for the bank. It's a liability for me. The asset has increased by 100,000. And because the deposits of Bank of Ceylon are essentially a liability for them, they have actually, that have increased by 1 lakh as well. So effectively what has happened, there is the balance sheet size of the, Bank of Ceylon has increased by 100,000. In this case, it is the activity of lending, the lending of 100,000, that is what has actually led to, deposits increasing by 100,000. That's the first premise, and we actually provide evidence of that. This is where our practical experience as bankers comes in, thinking about how does it actually work. Money gets credited, and deposits. Now, the second key part, when we think about the broad money in the economy, when we think about the broad money, what is it comprised of? It is comprised of basically the currency in circulation, together with the, with bank deposits. Now, in almost all economies, India, advanced economies, etc., the proportion of deposits in broad money is almost 90%. So if we take the broad money supply in the economy, 90% of that is, and these are empirical facts, almost between 85 to 90% is just deposits. So who is basically creating, and who's creating that deposit? Where is it coming from? It's coming from the banks. As I just explained, when they give a loan, that's when deposits go up. And who's doing that? It's not the central bank that is doing it. It is basically the banking sector that is doing it. So 90% of money creation is essentially happening through banks.
This is an AdaDerana live event.